Want a faster clear to close and fewer surprises? Underwriters study 5 documents very closely. I will show you what they are, why they matter, and how to avoid slowdowns. Welcome to Money House Media. Subscribe for more mortgage and financial clarity. Today we will cover the 5 documents underwriters actually read, the red flags they look for, and how to prep a clean file. What income documentation needed for underwriting? What it is: current pay stubs and W-2 or 1099. The underwriter checks year-to-date income and trends for bonus, overtime, and commission. Why it does it matters. Income supports your debt-to-income ratio. Common red flags: big swings in hours or commissions, gaps in employment, or mismatched names. What should you do? Send 30 days of recent pay stubs and last 2 years of W-2 or 1099 and add a short letter for any gaps. What else is needed? A full 1040 with schedules if needed, for example Schedule C or E or K1. Lenders may pull an IRS transcript with Form 4506C. Why does it matter? Write-offs lower taxable income, can lower qualifying income. Underwriters add back items like depreciation but subtract losses. Common red flags: large unreimbursed expenses, recent business losses, or returns that do not match transcripts. What to do? Send signed returns with all pages, 2 years if asked, and explain any year-over-year change. What it is: last 2 months of statements for any accounts used for down payment, closing costs, or reserves. Why it matters. Funds must be sourced and seasoned. Common red flags: large unexplained deposits, cash deposits, overdrafts, or missing pages. What to do? Include all pages, avoid cash deposits, and add a simple letter and proof for large transfers or gifts. What it is: a tri-merge credit report with scores, accounts, balances, payments, and any public records. Why it matters. This drives your debt-to-income ratio and can affect pricing. Common red flags: recent late payments, undisclosed loans, disputes, collections, or new debt during underwriting. What to avoid: opening a new credit, keep balances low, and resolve disputes before you apply. If student loans are deferred, expect a payment to be counted per program rules. What it is: the signed purchase agreement with all addendums, credits, concessions, and deadlines. Why it matters. The underwriter confirms price, seller credits, buyer-paid costs, occupancy, and timing. It must match loan disclosures and later the appraisal. Common red flags: missing initials, unapproved credits, conflicting dates, occupancy mismatches. What to do? Send the full executed contract and all addendums and update the lender when terms change. How to prep like a pro. Send complete and legible documents, avoid large cash deposits, respond fast to conditions, and keep your credit quiet until after closing. Recap: underwriters read income, tax returns, bank statements, credit, and the purchase contract. Clean versions of those 5 make approvals smoother and faster. Grab our free 10-step home buying guide using the link in the description below. Subscribe to Money House Media for weekly explainers. Educational only, not financial, tax, or legal advice. Programs and guidelines change. Talk to your licensed loan officer about your situation.